Hello, everyone. My name is Marcus Shobe, and I'm the owner of Revamp Your Finances LLC. Today, we're going to be talking about the balance sheet. What the balance sheet is, what does assets, liabilities, and equity mean? What does the balance sheet tell us? So let's just jump right in and get started. So the first thing is you notice on a balance sheet is, like I said, you have your asset, liabilities, and equity. So we have our assets right here, we have our liabilities right here, and we have our equity right here. Now, important to remember is the balance sheet. So people get confused. So balance sheet, if you look at the very bottom, it always has to be in balance. Your assets always have to equal your liabilities plus your equity. So we see our assets right here are 472,000, 472,100. 472,100. So if these numbers do not equal each other, then there's a problem somewhere. But if you use an accounting system such as QuickBooks or Wave or Xero or something else, these numbers will always equal each other. But like I said, if you're doing it manually, it's very much possible that these numbers might not equal each other. And if they don't, there's a problem somewhere because assets always have to equal liabilities plus equity. That is the accounting formula. If you don't remember anything else, you don't take anything else away from this video, assets have to equal liabilities plus equity. So the first section we have is assets. So you can think of assets as things you own. So we have our cash and cash equivalents, 100,000. Our accounts receivable, 20,000. Inventory, 15,000. You can think of this stuff as things we own as of this date, December 31st, 2,100. Don't get confused with this with the income statement when that's a per year number or per quarter number. The balance sheet is a cumulative number. So this is basically telling us on December 31st, Teddy Fad Inc. had $100,000 in its bank account right here, $100,000. On this date, December 31st, customers owe us $20,000. That's what accounts receivable means. That means we have provided the service to the customer, or we sold them something and they haven't paid us yet. So for example, if I come to you and cut your grass on today's date with October 7th, 2021, and you haven't paid me yet, that would be accounts receivable to me because I provided the service for you, which is cutting your grass, but you haven't paid me yet. That's what accounts receivable will be. 15,000. This represents the amount of inventory that we have as of this date again. Remember, everything is always as of the date, which is December 31st, 2,100. And we're not going to go over these two because they're kind of a little bit more complicated, but just remember, assets are things that you own. Now let's go to property, plant, and equipment. This is land. So this is basically telling us when we bought a building, which you see building and improvements right here, when you buy a building, you also get the land also. So the land that was assigned the value was 24,300. Now, the thing about land, buildings, and equipment is once we buy it, we don't write it up or down. So if we bought a building we just say 1950s, the property might have went up in value, but in accounting, we don't write it up. So if we paid $100,000 in 1950, it's still going to be $100,000 today on the balance sheet in 2021. That's called the historical cost principle. We do not write stuff up and down. We do not do that. Going on. So that leaves us with a total assets 472,100. I'll make a separate video on what intangible assets are and depreciation and all that stuff. But for now, just remember assets are things that you own. You own land, you own buildings, you own equipment, you own inventory, you own cash. You know, somebody still owes you money that we talked about earlier. That's something that you own even though you haven't got it yet. You're expecting payment because you provided the service. Liabilities are going to be people that we owe money to. So accounts payable, it's the flip side of accounts receivable. You get a bill in the mail from your cell phone company, we just say September 30th, but you don't pay it until October 7th. Well, if this balance sheet was as of September 30th, we're going to have accounts payable amount for that cell phone bill because we received a service because we was able to use our cell phone, but we haven't paid it yet. That's what accounts payable is going to be. Notes payable is going to work. Is basically going to work the same exact way. You know, we take out a note from the bank for $100,000. We're going to pay interest on that note until it comes due to maturity. So in this case, it's $10,000. So that's how much they still own. That's still how much they owe for the principal balance on this notes payable, $10,000. We're going to skip over accrued expenses and deferred revenue because those are a little bit more advanced stuff, but I'll probably make a separate video on that as well. And then you can think of long-term debt as, you know, something that's going to take longer than a year to pay off. So, you know, maybe you have a mortgage, a 30-year mortgage on your building. That's going to be long-term debt, anything over a year. A current liability is going to be something that you expect to pay within a year. Long-term debt is going to be something over a year that's going to take you to pay off. So now we see our total assets is $472,100. Our total liability is $247,000. So now let's move on to equity. Common stock. This is going to represent how much money was put into this company's stock. So it gets a little bit complicated. The equity part is a little bit more complicated than that. But just know this is going to have something to do with owners and, you know, owners taking money out of the business and shareholders putting money into the business. That's what the equity section is. This common stock is the money that shareholders have put into the company, $10,000. Retained earnings is the amount of profits that we've had cumulative over the years minus any dividends. So for example, last year, let's say our retained earnings was $20,000 and our profit was $10,000, but we paid $5,000 dividend out. So our new retained earnings balance would be, so we're going to start our beginning balance, which was $20,000 plus the $10,000 profit that we had minus the $5,000 dividend that we paid out. That's what that's going to be. And dividends can get a little bit confused also because anytime anytime a dividend is that you say you're going to pay a dividend out, that gets subtracted automatically from retained earnings. It doesn't represent the dividends that you've paid out. Once again, it gets a little bit more trickier than that, and I'll probably make some future videos explaining all this in detail. Treasury stock is going to be how much of the stock the company bought back. Treasury stock is always going to be negative. So in this case, Teddy Fab bought back $2,000 of its own stock for maybe various reasons. It could be a lot of reasons why. But that's what treasury stock is. Treasury stock is always going to be negative. And like I said, once again, total assets always have to equal total liabilities plus shareholders' equity. I really hope you enjoyed this video. I'm going to be creating more videos in the future explaining a little bit more of this stuff more and more detail. But in the gist is what the balance sheet is going to look like. Remember, it's as of a specific date and it's always cumulative. So like I said, in this example, this company on December 31st has $100,000 in the bank. You take care and I will see you soon.